Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another great episode of We Build Great Apartment Communities, the only place where you come to learn how to take apartment buildings and turn them into amazing communities. I'm your host, John Brackett. Welcome to the show. We have another great guest, and his name is Dan Kryzanowski.
Hey,
I said that right this time, right, Dan?
You got it well, my friend, and I will call you JB.
I nailed it. Man, so I am really excited to have you on the show, Dan, and you bring a unique flavor, a unique approach, some unique insights, and that's what this show is all about, is perspective to find ways to help our audience do things better, make smarter investments. And I think more importantly, through that profitable way of doing business, we are able to positively influence and build out some amazing communities and improve how people live along the way. So with that said, welcome to the show, man.
Awesome. John, thanks so much for having me today. Yeah, I'm humbled and honored just looking at the past guests you have. It's great to be here with you and your audience.
Awesome, man. We're really excited to have you. You know, we have a great show here. I know, Dan, that you're going to bring it, man. So Dan is an active real estate investor and fundraiser, leveraging self-directed IRA accounts and solo 401k accounts to create a diversified real estate portfolio yielding double-digit returns. He specializes in multifamily and other niche segments such as last mile industrial, Rust Belt retail, and suburban self-storage. Dan has personally raised millions of dollars from family offices and individuals and empowered his partners to raise seven figures on multiple occasions. So Dan, also a native to Pennsylvania, and lives with his wife and son in Austin, Texas. So hey, man, welcome to the show. Really excited to have you. Let's start with you sharing your story and how you got into this space.
Yeah, so the first 30 years of my life, pretty simple, and probably like most folks here, pending your age. I grew up in Scranton, PA, had a W-2 job. Everything was easy breezy. Worked for GE when they were the top company of the world. Had a few tastes here. I live in Austin, Texas, and kind of doing the commute on I-95 was not where I saw the world going. And so, with that said, maybe a bit of serendipity, but I was co-best men in a wedding, and talking, say, "What'd you do?" And the other gentleman says, "Hey, I flip houses," and I'm like, "Well, that sounds great," And I said, "What does that mean?" He says, 15% return. I said, "I'm in." And then, the big magic light bulb, he said, "Did you know you can use your retirement dollars?" And for me, this is just, my analytical mind, and also like you, my sense of community just started, going together. So I lightly made a small investment. And then over time, you really peel back the onion and say, wow, this is literally a 10 trillion, a multi-trillion dollar opportunity, a number that goes with our stimulus, our deficit. It's a huge number that, as folks are made aware, they can take their dollars and invest in their community, and probably the easiest and, you can argue the most attractive risk return is in, hard assets such as real estate.
Well, hey, I really appreciate the summary. I think it's kind of interesting, right, that inside of this space, as much education has happened around self-directing your IRA money or your retirement account money, right, 401k, IRA, solo 401k for that matter, there's still a small amount of the public that understands that this can actually happen. And so why do you think that is? I mean, there seems to be this friction taking shape, right? Where you have all this education being put into the area of helping people understand that they can self-direct their dollars into real estate investments. And then you have the other side of that spectrum that's very resistant to providing that information and having those conversations with their clients, right? So can you talk a little bit about that? Because for me, I think that's where the opportunity is, right? So can you elaborate on that a little bit?
Yeah, you're spot on. I mean, the high level answer, it's not country club cool, or historically it wasn't. So let's just take a quick step back. Self-directed IRAs, A, they're legal, B, they've been around since the 70s. But it's always been a hassle. Even when you hear the term custodian, you probably almost put on your lawyer hat, like, oh, I'm going to have to do some stuff. It's going to be a lot of steps. And historically, it wasn't crisp, clean, easy to do, just as how we're used to going online to do an online account, open a checking account, open a trading account, open a crowdfunding. That investors of all ages are used to now. Historically, it wasn't this way in the self-directed world. So yes, it may be advantageous if you somehow learned of this, you would go through the paperwork. I mean, when I opened my account, which is still one account I opened in the 2010s, I still needed a fax machine. Kind of wild, but that's the way that communication happened. So, with all that said, it just, a few people knew about it, a few sponsors, meaning like people raising money for deals. And, that was kind of it. So when you talk about generationally, think to the older end of Gen X, and using me as an example, kind of an earlier Gen Xer, you went to your job, you did this, you maxed out your 401k, you went into your, I don't know, Fidelity funds, your Vanguard funds. The next thing you know, you're 50, 60 years old. That's the way you were wired. So your $1 million 401k is going kind of in the 10 options that you have at your old employer. And that's kind of it. Same time, from a sponsorship level, it really wasn't as sophisticated. You would have folks, I think, that generally stayed in their neighborhood, found some investors, probably did some great deals, and would recycle that money and had a wonderful lifestyle. And I won't say lifestyle business was provided for their family, but for many years, the sponsor might have said, I'm very comfortable with 20 to 40 million of properties. And it pays me and my team of 3 folks, and that's great. What we've seen since then, as more folks said, well, I want to become national, I want to hyper focus on a niche like self storage, you need access to more money quicker. And the days of, say, I'm raising money for a $50, $100 million fund, an investor might say, I'm still interested, but I'm going to give you a check for each deal. I'm not going to give you kind of this large check. So, what we've seen, particularly over the last 10 years, is that frankly, the need for money, because of how much it's been recycled and on a deal by deal basis, you need to tap into another pool of money. So, like anything, enough people were aware of the self directed world. And as they became aware, they would set up their own custodian, or for folks that are self employed, think of the 1.3 million realtors across the country, something called the solo 401k, which, one advantage of that is that you can contribute over 50,000 a year, 100,000 plus if you're married. So there's different derivatives of these products out there, but the high level answer is it's been a lack of awareness for both the sponsor and the investor side, but we're seeing that change. And I think the big takeaway, particularly for anybody that's raising money out here, folks that have done this on a consistent basis tend to get 10 to 20% of their money coming from self-directed retirement accounts. So let's think, a real example. Why is this important? Well, one, I may have invested, John, with you before, but if you don't make me aware that I have 100,000 in my Roth account that I can invest with you, I'm never going to do that because I'm just not made aware. I think a second good example here, and is the most impactful for me, is somebody says, I have a few kids at pick your school, USC, et cetera, big private school, but I really want to invest in your deal. And I worked at for Boeing 30 years. I have $1 million 401k. If they are made aware, then this might be the only pool of money that they can tap into that they were completely unaware they can tap into. So once that connection is made, you see the transformation of money. So although, the piece of the pie of this 10 trillion I referenced before is only about 100 billion or so, that number from a year over year basis has been growing. So the momentum is there that you're slowly seeing more money go into private assets.
Okay, cool. So that's a really good share from the viewpoint of an operator, right? Saying, okay,
Hmm.
hey, now I have access to an additional capital source or via this path or this vehicle, meaning a self-directed IRA or self-directing rather dollars
Yes.
into a real estate investment, right? So great perspective. Now let's shift that a little bit and talk about the advantage to an investor, corporate entity. Can you talk about that a little bit? So let's use me as an example, right? I have a self-directed IRA account, have a custodian
Hmm.
on this for a couple of years now, probably 12 years now, right? So can you talk a little bit about the disconnect with an individual or consumers, right? The consumer population. And then, of course, the disconnect between an individual or individuals out there in the marketplace being able to take advantage of this strategy. And then the other side of that then would be the stock market, right?
Hmm.
I'll use myself as an example. Okay, Dan.
Sure.
So when I was 22 years old, right, I had my first chunk of money that I wanted to go and invest. And so, you know who I went to get advice from? My grandmother. I used her stockbroker, man.
Uh-huh.
Right? It didn't turn out too well. But inside of that world, there was never a conversation. I did that for several years, right?
Hmm.
I beat my head against the desk for several years, wondering right? Why this is not working out for me the way that it is for other people. Now, one of the reasons was I was just very young and I didn't have the
Mhm.
experience, right, or the wherewithal to really understand in depth what I was investing in. So I was relying on someone else to do that for me, right? I was literally abdicating that responsibility out to someone else. Don't do that anymore.
Yeah.
So, with that being said, maybe share with our audience, right? Because you're someone who lives in this world, why there's such a disconnect, why these
Mhm.
conversations don't happen regularly inside of these broker dealers. And when they do, they're for a very select few. So, can you talk about that a little bit?
Mhm.
Because that world is now opening up, right, with the world of private placements. I think it's really
Mhm.
giving the general public an opportunity to step into this space in a very unique way, right? And really take more
Sure.
control over their destiny versus putting that in the hands of someone else and literally hoping for the best, right? Can you talk
Yeah.
about that a little bit?
Yeah, absolutely. And I think you're spot on with your example. Particularly your grandmother had an advisor. I laugh because I think I invested in Radio Shack or service merchandise for my first one. So that my introduction to write-offs,
Right.
to say the least. But what you see is both, from the advising side, the advisor has been very proficient kind of in their bubble. And I'll preface to say, I still think having particularly stocks is good at any age in a portfolio. Some portion of your portfolio should have that. That said, the advisor is compensated, particularly say a big box brand name advisor is compensated on the money you have with them, and you're limited for what you can invest in. So, putting on my New York or Philly hat where I grew up, they're going to be pretty straight. Well, I want all your money, and that's that. We're a little bit nicer down here in Texas. We say it a little bit differently, but I think a lot of folks do not have the foresight. And I think what you're going to see when the market does have a dip one of these years, and naturally that'll happen. People say, wait, I've been paying my advisor this much, and I've been in a portfolio that looks real similar to an ETF. And at the same time, did this real estate deal and it paid, an 8% dividend and 15% IRR. And they'll compare that, say, versus their bond or just some portion sitting in cash, and they'll see a pretty obvious delta from this standpoint. So some of it, I would say the advisors are limited on, frankly, just for compliance reasons, what they could share, but the big thing, once again, it comes to just big awareness. So one thing, and I'm sure you've seen at some of the shows, pre-COVID when we went in person, a family office, a high net worth individual will say in front of open doors, hey folks, I may have less than 10% of my stuff in stocks, bonds, mutual funds. It's all in private assets, such as real estate. Somewhere where I have niche expertise like biotech, giving back to, the other side of the tracks in the community, which frankly, and I've seen the numbers play out in my personal portfolio, these actually pay more. So it's a huge win-win throughout. So I think as like anything, the money's going to drive the conversation. So as folks realize this is quick and easy to do to take back a portion of their retirement or not all, they're going to see that play. And a second thing I'd say, what I see, I think, folks kind of early mid-career that are an advisor, you come to a certain fork in the road where you can stay with kind of the big box and there's a lot of comfort. There's a lot of benefits in the research behind it, or to go on your own and be a true independent advisor. And this is where I think, as I like to say, you pretty up the pie chart to go into multiple sorts of asset classes. As I said, I mean, this isn't strictly just being like a GP, like, I like Kiyosaki, Rich Dad, Poor Dad, but just from natural diversification for what we call a 21st century diversified portfolio. This is really the way to go.
Did you just say a 21st century diversified portfolio?
It's a big
You
word for a
sound you
kid coming
sound
from
like the
Scranton, PA.
stockbroker man that my grandmother referred me to. What does that mean, Dan?
Your grand stockbroker was talking about 20th century. So,
Oh, nice one, man. Nice one. Good job, buddy.
and,
Good job.
and that's the 60/40. The 60 stock, the 40 bond. And I think what you're really seeing now is that, particularly with, bonds effectively 0 to 1% cash, CDs, things are pretty low that, the big aha moment, and actually my original boss at Merrill Lynch, who I invest my stock money with, we were at the dinner in Vegas, and he said, why do you think this, money's going to continue in the stock market? And I really didn't have a good reason. And then he said, the likes of a CalPERS, a pension fund, they have to put it somewhere. So kind of that whole 60/40 stock bond. Yes, some will still go into stocks, but bonds, cash, CDs, nearing zero, you have to do something a little more wise. So When you think of a 21st century, so let's stereotype a millennial here that's in a bunch of different crowdfunding, probably on a smaller real estate platform, they can put in $1,000. They are in multiple asset classes, much like, and you're seeing this turn everywhere from like the large sort of pension funds are moving into private assets, and of course, many hedge funds and family offices have been doing this for years. So you're starting to see what I think folks are naturally doing. Even I'd say the older generations have been doing with your piggy bank checking account money, a loan to a friend, investing in a restaurant, owning a few houses on the side. But folks generally, when they think of their big glut of money, which is their retirement, whether it's in an actual 401k IRA or just, the retirement set aside, it's been in
Okay.
the 60/40.
Now, this is my own personal insights that I'm going to share, okay, based on my
Okay.
experience. I'm going to challenge that. I'm going to give you a very different perspective, right? So, for one, I appreciate the summary because it's given some very good background information and insights for our audience. Now, we're going to talk about making money, okay? We're going to compare that to, or in this case, when we talk about making money, we're going to use, in this case, the vehicle that we're talking about right now, which is self-directing dollars into an investment vehicle to do that, right? So let me give you a different perspective, man, Dan.
Hmm.
Let's talk about the thing that's talked about least by any financial advisor, okay? Very rarely, almost never, in fact, maybe 0.00001% of the time. And guess what that is? Guess what the greatest asset is? Your and my greatest asset is. I'm going to share it, man.
Okay.
It's you and me. Okay. I'm my
Hmm.
greatest asset. Me. I have to wake up and I have to produce every day, right? You have to wake up and you have to produce every day. Okay. And so I'm my number one asset. You're your number one asset. And that's why inside of companies now, this whole thing about human capital that started years and years ago, right? But the point of the matter is you and me are our number one assets, our audience for that matter. And here's why, Dan, because everything starts with a decision from me, right? So consequently, understanding that now, I spend more time and energy and money making an investment in myself so that I can create more production, right?
Hmm.
Here's what has happened overall, okay, inside of this space is that the whole conversation has shifted to let me take your dollars so that I can help you retire more comfortably by being the advisor on your behalf, right? Okay, that is a Wall Street conversation that's been marketed for many, many years and now has kind of become mainstream. And guess what? Amazing marketing, right? I call it the marketing machine. But the
Hmm.
reality is, if you or me, we want to increase our income and we want to produce more and generate more, what we have to do, man, is make an additional investment in ourselves, right?
Sure.
That's just a reality. You are your number one asset. I am my number one asset. So if we want to increase our wealth, our incomes, we have to create a greater investment in ourselves. Okay, now let's shift. Okay. So this is where self-directing dollars comes into play. And this is why, in my opinion, in my humble opinion, I see this only getting greater and greater. Hence, the parallel is private placements are also increasing. And the reason for that is you have more and more people saying, okay, I am my greatest asset. What do I know really, really well? Right? I am a business owner. I am an entrepreneur. Consequently, I want to make investment in things that I really understand, right? That I have an intimate understanding about. Okay. That's why you see this market starting to grow at an exponential rate. We can build wealth faster by investing in things that we have direct influence over and that we really understand. So that's just a perspective. Okay. I'm not saying that's right or wrong, but I do see that in my world starting to pick up speed because I really do believe that more people are simply starting to understand that, when you've developed 20, 30 years of expertise in a specific area, it only makes sense for you to invest in what you know, right?
Hmm.
The outcomes are going to be much better. So, anyways, you talked about this trend taking place. And I think that's kind of the social economics behind that, maybe, if you will. So, what are your thoughts on that?
You're right. I was going to say time, which I think, because I think of time, what we can do on our limited time on this planet. So I agree. Yeah, ourselves and investing in yourself. And I also think educating others kind of from a mutual way is huge. But I do recognize also that capital, folks can do a lot with a little bit of capital if they're given that opportunity. My personal portfolio, it's invested in female entrepreneurs, persons of color, a few asset classes that I may not know as much about, but can have a huge impact. So, like curing a very specific type of cancer, but a very niche thing of somebody that has proven to focus on not the huge, but just a very micro thing that's going to greatly benefit, maybe a few thousand people. For me, that's a worthwhile investment. So this is, I think, kind of the spirit of crowdfunding that you see is folks can put a little bit to help a small business owner. That's kind of probably a restaurant, a bar. That's the most basic out there. But then you are seeing other platforms coming up that allows you to do that in different businesses for smaller real estate. I think as you share, there's other larger platforms that are now adding a few zeros onto those types of investments. I do think as folks get in their community and say, this is where I want to settle, this is where I want to make an impact. I just moved to Austin, I just moved to this city. I want to retire and move back downtown. And folks are sitting on funds. I mean, what's the point of dying with it or sitting in some stagnant fund, ABC mutual fund up on Wall Street? I think folks are feeling called to bring some of that money back, or of course their time into the community. And what they're seeing too is by the numbers, potentially you're doing as well or better, or just as we talked about before, just from diversification. It's good to have some of these kind of moonshots out there, and why not benefit in your community? And a final point, it's a little bit selfish, but my initial investments in the alternative space was in bars and restaurants. Very brave, but part of the reason, as a singleton, well, you got half price drinks. Or as you get a little bit older, you have access to the space for a meeting room. We actually used to meet in person pre-COVID. So with that, I think there's other, not just like I support a cause, but there's other things that this becomes part of, your story, your community. And you're also taking pride to say, I'm an owner or these are businesses I support, because then your community becomes more aware. So I think it's a very powerful tool. And at the same time, just as you are doing here in our podcast, we are naturally educating a larger audience. And then as we break off into one-on-one, we're going to learn something that, maybe we thought we knew, we were completely wrong, or we're going to have our learning, become exponential from one conversation with somebody. So, that's what I've seen. And I do think it's a pretty substantial delta of when you invest or make a loan, or you're just talking about it, or, clicking like. I do think it's an exponential difference here to really put your money where your mouth is in the community.
I appreciate the feedback, man. I think we're going to start seeing people are going to start taking back ownership over their investment decisions, right? And here's what's happened, okay? What's happened is, as a community, we've decided to, for whatever reason, abdicate out our decision-making process around investments, right? Around investing.
Mhm.
And I think the mechanism through which that has happened has been fear and complexity. All right. Now, I'm not going to get into that conversation, but what I will do is then talk about, okay, well, how can we start changing that, right? Now, that's going to be a lengthy conversation, but what I would like to do is talk about, where do I think I can generate the greatest return, okay, based on my experiences, right? For example, here's what typically happens. A business owner will take their dollars, their money, put it in a solo 401k, right? Or some type of retirement vehicle. And then for whatever reason, invest those dollars into equities that they have no idea about. When they're running a business in an industry that they're literally an expert in. Help me understand this, man. True story, okay? I have a buddy of mine, genius guy, genius.
Mhm.
And one day we're sitting down, he goes, "Hey, John, you're not going to believe this, man. I made the best investment ever." So we started talking about this, right? And I got really excited. I go, "Man, well, I want to hear this. Tell me. Show me the money, man." So what I learned really surprised me, right? And it was that he made an investment, same thing, right? Building up this retirement account, took a huge chunk of money, put it into a stock, and I'm not going to say which one. And that industry was in the complete opposite of what he has mastered over the last 30 years. So my question to him was, I said, hey man, I really appreciate you. You're like one of my best friends, but I think this is the stupidest thing you've ever done.
Mhm.
and
Yep.
and I said that with a huge amount of admiration for this guy, right? I mean,
Yeah.
we're just honest with each other like that. And he goes, hey John, well, why? So I started explaining this to him. I go, look, you've built up 30 years of mastery in this particular industry. I come to you all the time for advice. And instead of making an investment in a business in this industry that you absolutely understand better than I think anyone else that I personally know, right? You go and you make an investment in a business that you know nothing about, in an industry that you know nothing about. And it was all based on the advice of someone who's selling you into this thing that knows nothing about that industry either.
Yep.
So things got a little heated after that, but luckily, man, beer makes things fun
Yes.
and it brings everybody to reasonable terms most of the time, right? Okay, so the
Yeah.
point there being is the next day he called me and he said, hey, man, I really appreciate you having that discussion with me because I never looked at it like that. And I said, hey,
Mhm.
I never looked at it like that either until a couple years ago. So, Dan, the point there being is, I really believe that the education needs to be around people making investments in areas that they have mastery in, right? That doesn't have to be like, hey, I've been doing this for 30 years, but I've been doing this for 5 years. I'm going to spend the next 20 years in this industry.
Mhm.
Let me start speeding up my learning curve and my wealth by putting money in an industry that I'm going to spend more time in, right? That I'm going to build some mastery around. So, anyways, just a comment there for some experiences that I've
Mhm.
had and that I've had to learn from the hard way. So, just wanted to throw that out there and get your feedback, man.
Yeah, one thing, and thank you for sharing. You mentioned that self-directed. It's two things. So one, by kind of going on autopilot, you are self-directing, but I like to call it with a lowercase s, not really being in control with kind of the capital SD, as we talked about the 21st century diversification and playing on your story. I'm okay with going into something you're not an expert, but tiptoeing into it. So let's just use indexing terms. If your maximum investment in something you know really well, or somebody that you've had successes with time and time again, let's just say is $100,000. You can dip your toe in a crowdfunding for 100, 500. If you support a younger entrepreneur or you want to see how something's going at the seed round, you can probably get in for single digits in the thousand.
What are you getting in for, Dan?
Sure. So it could be multiple things. So one is from the learning perspective, the access to the community. As I shared before, there's a delta when you put real money versus no real money. And I've read recently a lot of angel investing. You're not really investing to make a profit. You're investing for the learning and the community. Once again, this isn't where you put in your big chip, but
Not
you
really
put in
learning
some of your.
for profit. Wait, say that again.
Sure. So, I mean, if you really take angel investing, for a lot of things do not make money. So you're not investing, although you want to make a profit, particularly when you can only invest in, say, a handful of startups versus like a VC that has the option to look at thousands of deals and et cetera. You're either supporting somebody from the standpoint that, let's go back to community. My relationship with you, for you to go on this endeavor, is better for the community, or for me selfishly in the long term, because of the relationship we'll develop and the people that you will introduce me to as being an early investor.
Yeah, you might want to preface that, man, by saying, hey, I
Oh, yeah.
think this might be the case or this is a theory. Because here's the reality, dude. If I ever had a conversation like that with any of my investors, and all of them have been with me now since 2008, every single one of them,
Mhm.
no one would ever do business with me again. Okay. And here's why. And it's even illogical for me to think this, right? That I can have a conversation with someone about making an investment and them losing money, but doing it just because it's going to fulfill a social need or a social benefit. Because the reality, man, is the person making the investment has worked extraordinarily hard, okay, 9 times out of 10, to be able to produce that savings and those resources to make an investment to begin with, right? And that's why it's completely illogical to think that someone's going to place technically their time and energy, okay, the byproduct being dollars, okay, it's just the currency of energy and time into something that's not going to produce a return.
Let me preface, I'm not saying it's absolutely not going to, but when you look at, and let me be crystal clear, you're talking of a small sliver of a very generic, as you said, portfolio here, a theoretical portfolio. I still feel, as we talked before, a majority should be hard assets, real estate. The stock market's proven itself for 100 plus years. Once again, go back to our new favorite term of the evening here, 21st century diversification. I'm telling you, but
Man, I
let's look at it.
appreciate you, man.
But a very fair point, though. It's kind of chicken and egg. Historically, people thought they could only put their money in the stock market, and then people think, well, I can only go with an operator that's been around the block, 20 times. And your investors may not have said it, but rewind, 10, 15 years, their investment may have been with you as saying, well, okay, this is the first time going around the block. So there was probably an element of trust in knowing that there was more perceived risk versus if they were to come and invest with you today.
Let me tell you why people invest with me, okay? It's really an easy answer. Is they know that I'm going to manage their money no different than my own. That's it. Fortunately, I've been able to produce the results that I tell them I'm going to do. And every time I've gotten into situations where those projects did not go as planned, I still found a way to the finish line, man,
Mm-hmm.
every single time. That's why people invest with me. Now, let me say this though, okay? And now many of those projects are some of our best performers, okay? Let me say this. I do believe that you can do both, right? You can make very wise and profitable investments and positively impact the community as well. But the only way to be able to positively impact community long term is you have to be profitable, man. You must be
Sure.
profitable as a company, as an apartment building. That investment must be profitable for you to be able to continue to plow back into the community, right?
Mm-hmm.
Continue to make investment in the community. So the position that we have taken in our company, okay, is we have built a culture around our purpose, which is a reflection of our show, right? Our purpose is to build great apartment communities and to improve how people live. And by doing that, by keeping that our purpose, it makes decisions very easy, right, for us because we're really clear on why we're doing what we do. But we also have a really clear understanding that the only way to do that consistently well long term is we have to be profitable.
Sure.
But here's kind of what we've learned over the past, in this case, about 8 years now, okay? This was a test, right? If we put people first, but we're really, really clear about our purpose, okay, and we started using real estate as the vehicle to influence communities, right? Focused on profits,
Mm-hmm.
right? The thing was that when you really focus on the people inside of your community and they're happy, your margins go up. They go way up, right? And so that's the win. That's the opportunity. But what people won't talk about, Dan, is what you really need to drive that outside of a great buying opportunity and a great management team is strong leadership. That's a very difficult message to communicate and actually execute on, right? Especially if you're dealing with third-party property managers because you have competing agendas. Topic of another discussion. But anyways, man, I just wanted to share that with you because I think what you're saying is really cool. There's a lot of really great things about it, some really cool insights. And I think this is a really important topic, very, very important topic. And there are a lot of resources out there where people can participate inside of something that they know and make a lot of money doing it, right? So, man, I really appreciate your commentary. So Dan, we are approaching the end of our show, man. This has been a really cool conversation. So share something, a tip, Dan, that you feel our audience can walk away with. I call it a money-making tip, a wealth-building tip. Let's actually change it to a wealth-building tip. So can you share a wealth-building tip with our audience before we start winding down this show?
Sure. If real estate's your thing, there are multiple tax benefits from being an owner. So a GP versus just an LP investor. I'm not a tax attorney, so I won't go into anything there, but there are, in terms of building wealth, as you said, this provides a huge base for, at the true bottom line, that more money falls into your pocket and you can do a whole lot more with it on a year-over-year basis.
Awesome, man. Dan, I really appreciate you, buddy. Hey, before I ask you to share with our audience the best way to get in touch with you, what is the one question, Dan, that you have of me that you think can add some value to our audience?
Yeah. So, in terms of once you guys invest back in the community, what's your call to action to them, or what resonates most? You touched, I mean, multiple communities. Do you share with kind of a specific call to action, or what in your story has resonated the most that they can share with others? Kind of a butterfly effect.
Are you asking me this from the viewpoint of the investor, or from the residents in our community, or from our staff?
Say from the staff and residents.
Okay, so let me just make sure I understand the question, right? If I heard that correctly, you're saying, hey, John, what message resonates most with your staff and your residents?
Yes.
Okay, all right. That's actually a really good question, man. Let me start by saying this, okay? One of the things that I had to change is the fact that I was a very weak communicator.
Get out of here.
Really? I had to change that. True story, okay? And this started from an experience that I had at a commercial bank where I had ownership in the bank, right? Put together a deal, had ownership in a bank. And what I failed to realize was I had really good ideas, but I was really poor at communicating those ideas to, at the time, the president, to move those ideas forward. So effectively, I wasn't very good at communicating a message, right? Okay, with that said, I learned from that. Okay, I've learned from that and I've been able to apply that forward, right? So fast forward to what we're talking about today. The biggest thing that I've learned, Dan, is you have to be really good at communicating a message. Some people call it a vision. Some people call it a purpose. I love purpose better than vision. I think most people can attach themselves to that much more effectively, right? And for us, there's a lot of clarity around a purpose. But I think it's going to be really important to be able to communicate a message, be really clear on what that message is, and be able to communicate that effectively. Now, here's the key: in a way that people understand how it's impacting the lives of not only the people that they're serving, but themselves. Okay? And finally, if you yourself as a leader, you aren't living that, just throw it in the trash. It's not going to work. Just forget about it. Save yourself some time and just throw it away. Start over. It's not going to work. I made that mistake too. Hopefully that makes sense.
Perfect. Thank you.
Anytime, man. Dan, I really appreciate having you on, buddy. This has been a really cool conversation. And man, I love some of your analogies too. I think I may use a couple, if you don't mind.
Take them all. Merry Christmas.
So, buddy, what is the best way for people to find you?
LinkedIn is the best. And, of course, please reference, that you heard it here with John, and be happy to continue the conversation.
Awesome. And hey, I want to thank you again for being on. You've been a tremendous guest. Love the insights. Look forward to seeing you, in the near future. And also want to wish you continued success, man. Thank you so much for being on.
Likewise. Thanks.
Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.